So thank you for joining us. I can see there's a couple more people still coming in. I think first of all, really in the position and situation we're in, we just wanted to kind of give a big thanks to and mention more than anything else to our NHS and frontline staff, that key workers that are doing a fantastic job in these times. So before we start talking about the investing side and what can happen and what we can do in a crisis like this, we just wanted to thank them for the work that they're putting in and the support and the hours certainly that they've been putting into this. So I know there are other people in the communities are doing different things in our area. This evening at 8 o'clock, they're all going outside to clap for the NHS and key workers, which I thought was quite nice. So a little bit different, a little bit of a different start, but I think it's important to recognise them. So we're going to jump on into this webinar, and I'm very happy that we've got a really good guest with us today. So I'm going to introduce him shortly and let him kind of give you a bit of an overview of his background. I can see there's a few more people still coming in now, but we'll start anyway. We are going to record this. It is being recorded. We'll happily share it at the end if anybody would like to review any particular point or comment or statistic, because it's quite heavily led in statistics today. Just reviewing different areas. So obviously the webinar is talking about investing during the coronavirus, the crisis as such. Let's get this going. So my name's Stephen Moss. I'm the Managing Director of Sourced. This presentation is brought to you by our Sourced Capital arm of our business. So I've been in the property investing sector for 20 years. We've developed a lot of properties, converted, invested in lots of different types of schemes, commercial and residential as well, and obviously operates a peer-to-peer lending platform through Sourced Capital. So that's really where my experience is coming into this, and a lot of people will have seen webinars that we do quite regularly, or reports in different markets or different types of investments and opportunities that we're always pushing forward. So if you haven't seen anything, please follow us on social media, because we do publish a lot of things on our social media, so you'll be able to get a good insight there. As I said earlier, I'm very pleased to introduce Manish from Invest Like a Pro. Manish is with us on the webinar. Can you hear me, Manish?
Yeah, I can hear you okay. Can you hear me?
Yeah, fantastic. Excellent. Well, that's one big tick in the box already. So usually that's where it goes wrong. So yeah, Manish, if you could, firstly, thank you very much for your time today, coming on and sharing your experience and kind of what to do in crisis like this. And if you could give the guys that are on the webinar a bit of an overview of your background and history, that'd be fantastic.
Yeah, sure, and thanks very much for having me on, Steve. And just to echo what you said earlier in terms of the job the NHS is doing, it's times like these when you really appreciate the hard work that they put in. So feeling grateful that we've got a great NHS service in this country. Absolutely. In terms of my background, yeah, I'm a professional investor. So I've got 18 years experience investing professionally. So I used to work for JP Morgan, managed money for JP Morgan and other sort of blue chip investment houses. Most of my background was investing in equities and fixed income and sort of liquid assets, but I've also done property throughout. And so I sort of cut my teeth on due diligence and investment analysis, managing money for these names. And more recently, I've moved over to the property side, focused more on the property side of things. So both in terms of direct property and also investing in secured loans, which is kind of where I'm putting in most of my effort and actually most of my capital over the last 3 or 4 years. And so I run a website called investlikeapro.co.uk, where a collection of investors, high net worth and sophisticated investors who are interested in investing into secured loan opportunities, the likes of what you would see at Sourced Capital. And so we do the due diligence, we do independent external due diligence on the types of opportunities that you see coming through. So yeah, I'll leave it at that. We'll sort of go into more detail in terms of what I do when I look at these opportunities. We'll go into more detail later, but that's the sort of background.
Fantastic. And I can vouch for one, obviously, having gone through the process with you, Manish, a number of times, just how sort of detailed and, how much you delve into these investments as well. So it's good to have your experience on board, and, looking forward to sharing some of the information with our listeners as well today. So let's jump into it, hey?
Yeah, sounds good.
Fantastic. So the first thing we wanted to do was look at, obviously we're sat in the middle of a crisis. We don't know yet as to how long this is going to be. A lot of investors, particularly ones that I speak to, have a perception quite differently than sort of 2008, 2007 when the market crashed down, in terms of at that point they couldn't see a light at the end of the tunnel. They struggled to see, well, there are banks collapsing, how is this going to start to rebuild and at what point? Whereas with this, a lot of investors that I'm speaking to have more of an opinion of the there's been outbreaks in the past. There will become a cure. There will become a light at the end of the tunnel, and hopefully move forward. So I thought it'd be a really good point to start looking at previous outbreaks and what's happened in the past and how that's affected different types of markets. So we've got SARS in 2003. We have swine flu in 2009. Ebola in 2014. We have Zika in 2016. So they're the kind of outbreaks that have maybe not gone quite to this level that we're seeing at the moment, but certainly made impacts and certainly had effects on the markets. And this is a real nice kind of overview of the different outbreaks and the times it's taken after a 3-month period where the recovery was. So you can see you've got SARS, swine flu, Ebola, Zika. And on the back of those, then you're looking at the first dark blue one is from the start to the crisis peak. You've got 1 month after the peak, so then the recovery phase, and the percentage along the side is therefore 10%, 20%, 30%, 40% in terms of how much the percentage it recovered during that period. So you can see, a lot of the outbreaks after the kind of crisis peak started to really ramp up in terms of the first quarter for recovery, apart from Ebola, which obviously was a little bit slower, and it had different effects on different markets. So one of the markets we've focused on and we've kind of picked out is to look at the SARS, and particularly looking at what sectors in that market were affected more so. So if you look down this graph on the left-hand side of the bar chart compared to the right, you can see on the left-hand side the period of December the 2nd, 2002 to April the 24th, 2003, and then the April 2003 to July 2003. And we're looking here at how it's been affected and then the recovery. And that's probably one of the important parts, is the recovery and what's happened after that period. So the biggest losers with this outbreak were luxury, leisure, and travel. Travel is always one that kind of gets brought in for any sort of outbreak because it affects people traveling to and from different areas, etc. What's interesting from my point of view, and obviously we're predominantly biased towards real estate, is how real estate recovered. What's interesting, when we were talking about it earlier from like Manish, is Manish often discusses, and part of this presentation is going to touch on, is having diverse investments and the benefits of those. And you can see in here, the diversified financials, recovered very quickly and was one of the key kind of growth areas. So all these statistics, as I say, and graphs, we're going to be able to share along with the recording, so you can delve into these a little bit more. And we're going to do that with some of the stats we go into in a little bit more detail as we go through. Over the past few weeks, I think it's important to kind of review what's happened very recently. But obviously, a lot of people are aware that the UK index has dropped by more than 10%, which is the worst since 1987. In the same respect as well, the US, the Dow, S&P 500, also seen the steepest falls since 1987 as well. So it's having a global effect, which I'm sure people are seeing on the television and through the media as well. What we want to do is discuss that in a little bit more detail, but also look at what markets and what our views are, how it can change and going forward. A lot of people we speak to, particularly smaller investors or investors that are looking to come into the market, might look at the stock market fall and think, okay, well, this doesn't affect my day-to-day. This isn't affecting me directly. So I'm not currently investing, or I'm currently researching on how to invest, or you might have a transfer taking place, whether it's pension or ISA or something, to get yourself into a position to invest. But it's important to think about the bigger picture, how this affects the likes of pensions in particular. So, with stock market being reduced, savings pots obviously aren't growing as much, they're not performing to the levels they're expected. So big rises and falls can affect your pension. And that might mean that you have to look for alternative ways to make that money up, whether it's investing through a different medium or a different type of class. And it'll be interesting, particularly Manish's section of his presentation, looking at the different types of classes of investment and how they perform, and where best to potentially invest as well. Property, as I say, from our background, we are relatively biased in that respect, but it's one of the last asset classes to be affected by a crisis typically. And I think anybody that's watching this in the property sector will probably confirm this, that the property market we're seeing from a frontline estate agency point of view slowing down, less viewings taking place, and particularly with a lockdown at the moment, we're seeing that surveys can't take place, and there are other areas that are stopping the process. So there is still a demand, and there's certainly a demand from a buyer's point of view, because people are feeling it's a great time to buy. We can get really good opportunities, but actually, what's the bottleneck that's stopping that taking place? There's a really good quote here from Forbes journalist Gary Barker in previous outbreaks, discussing that the property market in recovery stage went up by 10.1% after the swine flu. So, if you look at the real estate in particular and the class, and once we've kind of hit that peak and we start entering the recovery stage, typically that follows that the growth and the cycle of growth in property. So the property cycle is something we're going to touch on today as well. We're going to look at what stage we feel we're at and what stage we were at before, because probably like most people in the property sector, they've started 2020 thinking this is actually going to be a really good year. We've got lots going on. The market's getting busier. We can see this being really, really promising. And then obviously this crisis has hit, so it'd be interesting to find out. Feeding back on the point about the pension and how the stocks and shares and the drop, and particularly the interest rate being reduced, it's important to take control of your pension. It's important to understand what the options are available. So we do have free downloads, and throughout the presentation, we'll just point you to our resources page. Feel free to have a browse through there, see if there's any information you'd like to download. There's information about what you can do in terms of pensions, types of pensions that are suited for you, and other types of investment structures as well. So I'm going to hand this over to you, Manish. You're going to give us a bit more information about the different types of investments and returns over the last 5 years and compare. And if you'd like me to push the clicker at any point, just please feel free to shout.
Sure. Okay. So so this chart is it's something I did for, I don't know if you guys subscribe to Property Investor News, the magazine. So Richard Bowser, who's the editor, he asked me to do a sort of 5-year. This was well before the coronavirus kind of crisis took hold. So this was back in January, February time, and he asked me to do some research into the various asset classes which private investors are interested in, and to do a comparison between the asset classes in terms of their returns, their risk, and the effort levels. And so this chart is from that article actually. And when I looked at the 5-year performance, these were the results. So we've got leveraged direct property, which was at 58%. But the second highest performance was in secured property loans. And a lot of people were kind of surprised about that, because they weren't expecting that to be the second best performer, You know, some people might have expected equities, which is in red in terms of the FTSE 100 index, but you know, it outperformed on a 5-year basis. And I myself was you know, somewhat surprised at, you know, how well that had performed. And it's not just the performance, it's the consistency of that performance year in, year out. And so this is showing how the returns compared between those asset classes. And you know, what I always say to people is, okay, returns are one thing, but you know, whenever you're looking at any investment opportunity, you know, the other side of the coin, which you don't often hear about, is the risk level. And so you have returns, but always check on, you know, what the risk level is compared to that particular investment opportunity. You might be offered something with you know, huge returns of 20, 30, 40, 50%, but if you don't know the risk level, you can't really make an assessment in terms of how good that investment opportunity is. So if we can move on to, I think we've got a risk comparison on the next chart. Yeah, there we go. So what I did was I put together those returns onto a chart, and also putting in the risk for each of those asset classes. So the risk is defined in terms of the volatility of those returns. Okay, so you know, that's a good way to measure the riskiness of something. How have those returns changed over the last 5 years? How volatile have the returns been? And so the one outlier here, you can see the FTSE 100 index. And again, this data doesn't even include what we've just seen now in terms of the collapse. This data takes from 2014 to 2019. So we can see that there's huge volatility in the equity indices, even before we have a crisis. And the least volatile of all of these asset classes were secured property loans. You know, we saw very, very consistent returns year in, year out of around 8 to 10% on average across the market. And so you get, you know, that combination of good, solid returns and very low risk makes this asset class, for me, you know, really attractive over the long term. And that's, you know, one of the reasons why I've decided to put more of my money into this asset class over the long term. Oh, I don't know what have you got on the next slide, Steve? If you can move over to the next. Yeah, okay. So this is just another sort of visual representation of the volatility, and the previous slide, the numbers on that were taken from these numbers, and you know, visually you can see how volatile the FTSE 100 has been, and equities in general. But the almost the sort of oasis, the calm, you know, the asset class which has shown the lowest volatility is the blue line, right? So the secured property loans, and look how consistent we've seen, you know, very, very steady 8 to 10% year in, year out in terms of returns. And so just another way of looking at how you know, low the volatility has been in this. And if we were to take recent events for equities, you know, that red line would be straight back down in 2020 year to date.
That's really interesting to see it laid out in that way, Manish. It kind of, you hear, I suppose, lots and lots of different conflicting information. And generally speaking, it comes from, depending on what people are trying to sell, doesn't it? Let's be honest with each other. And that's probably what a lot of people are kind of considering. But you've done this more along the lines of quite an independent view, to say, you know, let's take all this information and put it into quite a visual presentation, which straight away catches your eye. I think makes you think, wow, you know, and without it, it'd be really interesting to see the FTSE 100, how that's been affected now with the crisis as well. So maybe that's,
yeah.
Well,
that's yeah, that's off the charts. So you know, the FTSE 100 year to date is down what, 35% year to date. So that's off the scale. And you know, that goes with the territory. So you know, when you're looking at equities, you have to accept that there's volatility this year, much more than what is normally the case. But that kind of goes with the territory as well. And you know, what you've just said, you know, this is all based on actual historical data. So we're not looking at, you know, any particular opportunities. We've got the FTSE 100 actual returns. We've got secured loans, which were taken off a published index, and direct property from land registry data. So these are all sort of independent numbers we've seen.
No, no, fantastic. As I say, it's nice to actually see it laid out in this format, so it's really encouraging. Anybody that is watching, if you do have any questions, feel free to type them in, because you know, we will have a question section at the end, but I can add them in if there's anything relevant for the particular slide. I'm more than happy to jump on or pass it over to Manish so we can answer as well. So, no, fantastic. Do you want me to jump on to the next one for you?
Yeah,
Manish?
please. Yeah. Okay, so the final comparison I did was on the hassle factor, or the effort required in managing these investments, and I compared that against those returns that we've just seen. And you know, the easiest asset class to get into is you know, stock market. So if you've got yourself a you know, a platform, whether it's Vanguard or Hargreaves Lansdown or whatever, it's the easiest thing to do to invest. Just a few clicks and you can invest. Secured property loans are also very easy to invest in, and you know, you have the likes of platforms such as Sourced. Again, just a few clicks. But the reason I've given it a higher effort or hassle factor is that, you know, you need to just do your due diligence. You need to be able to select the right opportunities, and so you can't just buy an index fund or an ETF of these things. You have to be, you know, selective. And so it's slightly more, but the actual process of investing is very, very easy. And the highest hassle factor is with property and leveraged property, because you know, you need to negotiate with the vendor, you need to find the right properties, you need to negotiate your mortgage, and you know, go through that whole legal process, not to mention all the management of tenants and maintenance and all of that. So this is just you know, in one graph it shows you the effort versus returns. And again, you know, the secured property loans, they score well because you get, you know, very consistent, very good returns, and you've got relatively low effort as well. So again, another reason why, you know, if you're a passive investor, if you've got capital that you want to invest in, you know, this is a really good asset class which you can get exposure to easily and quickly, and you know, get good returns at the same time.
No, that's fantastic. I like that. I like the fact that you can actually look at it and see, you know, the different levels of commitment or time and energy that you've got to put into it. One question that just pops up from Richard is, I think you might have missed because you did touch on it slightly, is the data sources for the different asset classes apart from the FTSE. Are you able just to touch on that again, Manish? Sorry, where you kind of pulled this data in?
Yeah, sure. So the FTSE 100 index is just regular. It's the published data on FTSE 100. All of these, by the way, all of these include dividends or rent for the property. So I factored in you know, any income you get. So the FTSE 100 index is the FTSE 100 index. The secured property loans has been taken from a published index published by LendInvest, who take secured loans, short to medium term secured loans, and put together in a basket to create an index. And the direct property is from the land registry data, and I've taken leveraged and I've distinguished between leveraged and unleveraged. So when you get leveraged, I've applied a 67% loan to value, and it includes income, i.e. the rent, and it includes your mortgage payments on that as well.
Fantastic. One of the questions that's just popped up as well by one of the guys watching is regards to the secured property loans. Is the interest based on compound?
No, it's not based on compound. So if so again, you know, if I had compounded it, it would have been much higher. So this is based on simple interest, which is received on an annual basis.
Fantastic.
Which is interesting because the equity index, I have included dividends on that. So it's a slight mismatch, but you know, it makes the case for secured property loans even better.
Yeah, absolutely. Obviously, compounding the interest is well, it's a very powerful return, isn't it, when you start
It is.
in it, etc. But
Yeah, huge. Yeah.
I know that you've kind of put this together, and it's brilliant. It kind of gives people a really good insight and overview. And as you say, you've shared this, what was produced for Property Investment News, which is a great magazine. Have you had any questions or thoughts brought to you since releasing it that you thought actually that's quite good, or something you can share with the guys that are watching since it's been released?
Yeah, one of the most commonly suggested questions is on the choice of index I use for equities. So, a lot of people invest in global equities, and the reason I decided to go with the FTSE 100 is because it compares like for like, because everything else is UK based. So property loans and direct property, we've used UK assets there. So I thought it would be better to have like for like comparisons here. And also, when you invest globally, if you invest in the US or Europe, what also comes into it is currency. So, we all know that sterling, since the Brexit vote, has come down massively. So all of our equity holdings until the beginning of this year had done well for global equities. And a lot of that reason for doing well is actually currency related, because sterling's been so weak. So we kind of need to take that out of the equation. And if you invest in the FTSE, then you don't have that currency risk as well. So that was, I guess, one of the things that came out of this. And by the way, if anyone wants to see the whole article, it's there in full on my website, so investlikeapro.co.uk. So there's a lot more sort of commentary around each of these stats as well.
That was a really good plug, that, Manish. That's good.
Seamless.
I'm joking. It's seamless, mate. Yeah, seamless. Fantastic. Great, excellent. So, I think we've just got somebody else just asked another question about it before we move on. No, as I say, we are going to get time to come back and answer any other questions that do pop up throughout the process. So feel free to share them on the chat as we go through. And obviously, this is the kind of overview and the comparison, I suppose.
Yeah, so it's the same chart as the one before, except I've added a diversified portfolio. So all I've done very simply is take each of those asset classes, the other asset classes, and given them a 1/3 weight each. Okay, so I've sort of combined them into a diversified portfolio. And when you do this, diversification is great, because we all know how effective diversification is in terms of reducing risk. But it's also magical, because when you combine different assets together, the overall risk is lower than the sum of parts. And there's a kind of whole mathematical explanation for that, which we don't need to worry about. But the key thing I'm trying to illustrate here is that, and this is what I say to everyone, it's really good to diversify your portfolio and have in different asset classes. Some people are kind of very heavily weighted towards equities or property, and they don't have, when I've asked people, they don't have a huge amount of exposure in percentage terms to secured property loans. And when you do that, it reduces your overall risk and your returns, improves your returns against your risk, and it's just a good practice to be diversified. And this just shows what you can achieve by diversifying, because the overall risk is shifted to the left. That black dot is if you took the sort of numerical average of the blue, green, and red dots, that would be a lot higher. But when you diversify, it brings it to a lower level. So that's what I wanted to illustrate here.
It's interesting you say that, Manish, because we talk quite often about diversifying your portfolio and ensuring that you're spreading the risk as much as possible. We still often come across a lot of people, not just a couple of people we meet every now and then, but still quite a large portion of investors we deal with generally put a large portion of their investment or savings into one particular class. And do you think that's just because they're comfortable, that they're confident with it, they experience or they've done well with it in the past, or it's often quite hard, isn't it, to talk to people to say, look, we have people that come to us sometimes and they'll say, we've got this much in a pot. In fact, I was talking to an investor last week and he's looking at putting quite a large lump sum of money into a property loan, not with ourselves, but with a company. And my response was, well, personally, it's a risk there. Even if you don't put it all into one, you can put it across different property loans. And again, straight away that reduces your risk, but also keep in mind the other areas and ways that you can invest as well.
Yeah, I think it's kind of, there's two things. So one is kind of emotional, and we all have our kind of emotional attachments. We see an opportunity we like, and we've done some work on it, and we think, okay, this is great because I've just done all this work on it, and let's put a large amount into this because we're confident about the things that we've done work on. But actually, that brings a bias into your thinking, and what we should really be doing is diversifying. What I always say to people is that if you've got a pot that you want to dedicate to any one asset class, let's take secured property loans. If you've got a pot of capital, divide it into 5, 6, 7, 8 different parts, and spread your capital across different opportunities, because that's where you're not exposed to any one particular region or one particular type of developer or type of sector or the geographical city. It's just sensible to diversify your exposure and your risks to different things. And the other thing I would say is that when you go to see your regular IFA, IFAs have a big bias towards stocks because that's what their training has led them to tell people to invest in stock markets or fixed income or funds and whatever. And what they often don't tell you about is peer-to-peer loans and even property. And A, because they're comfortable doing funds and stocks, and B, they don't really get paid to give you advice on these other asset classes. The whole IFA industry is geared up to kind of to influence you to invest into stocks and funds, and that's how it's always been. So that's why I have some really good IFA friends, and some of them are really good, and they tell you about property and peer-to-peer and all the rest of it. But most of them are not really that well set up to advise you on this kind of thing. So you kind of have to, you need to have an overall sort of high level view, despite what other people are telling you.
It's funny you say that because we've got an IFA ourselves, and personally, other IFA friends, etc. And when we first started talking about this, their response was, oh, it's high risk. And then when you actually speak to them, because you're personal, you're friends, and you can speak openly, it's actually, well, we don't get paid from it. So therefore, they use this banner of high risk, and it's quite interesting to see that this kind of laid out in the format that you've done to see, well, what is the risk in comparison as well.
Yeah, well, it's I mean, it's plain to see, isn't it? I mean, what they're talking about is their own feelings or the media or whatever. But when you actually look at the hard numbers in terms of risk, and these are all first charge. So by the way, what we've got laid out here are all first charge loans. And okay, if you invest in sort of the riskier end equity opportunities, or some second charge with high LTVs and things like that, then you're exposed to higher risks, but you get high returns. But here we're looking at relatively secure first charge loans legally secured over UK property with reasonable LTVs. So and IFAs don't really have the level of experience to kind of distinguish between what the media is telling you and what the actual numbers are showing. So yeah.
No, absolutely. I've just had a question that just popped in, and it's a little bit different. So we're kind of going off script completely here, Manish, which you'll find if you're joining any of our other webinars. This always happens, but we've got a gentleman on who's watching, Andrew, who very experienced. Andrew's actually just written a book, which I keep meaning to say to Manish, I'll send you a copy. And he's just popped up to say, is there any way I can just jump on to say, I've got a point about the diversification that I'd like to just share. So if it's okay with yourself, Manish, I'm going to, hopefully, if this all works well, Andrew should be present. Hello, Andrew, can you hear us?
Hello, Steve, can you hear me?
We can hear you, yeah. How are you, sir?
I'm good. Hello, Manish, and thank you very much for a most interesting and informative presentation. Really like it.
Thank you, Andrew, yeah.
Yeah, I just wanted to make one point about risk, and I know that the standard textbook measure of risk is volatility. But, and when I was an equity investor primarily, I accepted that. But as I've gone into retirement years, my attitude towards risk has shifted. And what matters to me more now is loss of original capital. And I think that that's another aspect, another parameter that you might want to consider, particularly for older investors, that not only do the secured property loans have less volatility year by year, but they have a lower risk of loss of original capital. And that, for someone who's investing cautiously their hard-earned money over years, is a very important aspect of risk. And so I would argue actually against diversification between asset classes on that for myself, because actually I feel more secure having a portfolio of a range of different secured property loans. I'd love your response to that.
Yeah, that's a really good point, Andrew. You know, very good point. It's a very valid point. And it's a point I considered when I was writing this article. The problem you have is when you're comparing across different asset classes, you kind of need a standardized measure to measure that risk. And so when you're looking at equities and property, it's kind of hard to put in a measure about loss, a sort of loss measure on this. And for property loans, you can have default rates, which actually happen to be very low for first charge loans. And, we're talking sort of below 3% actually. And even during the global financial crisis in 0809, default rates on first charge loans were actually, very, very low. We're talking about low single digits. So, that shows, how secure these are. But when you're sort of comparing against all of these other different asset classes, it's kind of, you're not kind of comparing apples with apples in terms of a standard measure of volatility. So that's the reason I didn't put the loss rates on there. But, very, very, very good point, Andrew.
Thank you very much. Thank you.
I think it kind of summarised that you have to do your own research and you take into account your circumstances, don't you, Andrew? I think that's quite a good point. But no, thank you for jumping on board. I know I thought you were just going to shamelessly plug your book to let everybody know about that as well. So are we live on? You leave that to me. Well, as long as there's a commission. Are we live on Amazon yet with the book? I know we've been waiting.
Unfortunately not. I guess it must be the virus thing, but it was supposed to go live on Monday, and I'm still waiting for it to happen. But any day now.
Fantastic. And if people wanted to find that, it's written by yourself, Andrew Singer. And just remind me the name of the book, Andrew.
It's called Investing in Property Development Loans.
Fantastic, excellent.
Property development loans are a particular type of secured property loans, basically.
Yeah, excellent stuff. No, thank you very much for jumping on board. I'll let you go. Thanks, Andrew.
Thank you.
Enjoy the rest of the webinar. Take care. Bye-bye.
Bye.
Hi, Manish.
Hi.
You still on yet? I've not cut everybody off. Fantastic. We're still there.
Yeah, no, that was a really good question. Guys. Yeah, I just wanted to add to what I said earlier. And if anyone's looking at this space, investing into property for, as a sort of as an armchair investor, as a passive investor, there are three types. There are three categories of investments. So one is, within secure property loans, you get first charge and you get second charge loans, and second charge are obviously more risky than first charge. And then you have equity investments, and those are the three main categories. And what Andrew said is a really good point, because each of those three categories have different risk levels and different loss rates or default rates. And you have at the one end of the spectrum, you have first charge loans, which I said earlier has demonstrated very, very low rates of default, especially if you pick the right ones with the right security, right LTVs. It would take a huge crisis for those to default. And at the other end, we've seen a lot of equity investments default, particularly since the Brexit vote and over the last 3 or 4 years. So a lot of those have been in trouble. So just bear that in mind as investors, that you have those different risk return kind of trade-offs there.
Yeah, absolutely. No, really good question. Thanks for that, Andrew. I know another question just popped up, but we'll jump onto those towards the end, because we are.
And sorry, I just want to say sorry, Steve,
yeah, sure.
to interrupt you.
No,
one thing I would urge any investor to be very careful about is that you often get, when you're talking to promoters and property developers, you often get opportunities coming through, which are, they give you they don't give you the full security that you get with first charge loans, but you're effectively taking on equity risk for debt returns. So you often get paid 10, 12%, 8 to 12%, but you're not getting any security. You're not getting that legal security that you get with the solid types of opportunities that I look for, and that you also offer on your platform. And so the worst type of opportunities would be those where you're not getting the security, but you're getting a relatively low return. And so those are the sort of equity risk and debt returns, which are the worst combination you can go for. So just be aware of those.
Yeah, that's it. One of the key elements to any investing is the security. Again, it's amazing the amount of people do invest into particularly property projects where they're happy to have no security or a second charge security when it's not it's not as stable or secure as the first charge, which is what we work great with.
Yeah, and a lot of people offer personal guarantees and sort of debentures and restrictions and those kind of things, which some of them are not worth the paper they're written on, honestly. So just be careful of those.
Absolutely. Fantastic. Well, I know we're going over a little bit, guys, so apologies. So we'll jump back into the presentation. Obviously, bank rates, the interest rate has reduced to 0.1%, which I think it was quite a big shock to everybody. And it's the first time in 325-year history. So although that can affect your savings and it can affect your pension, it does also offer opportunity as well. And this kind of overview just gives you an insight in terms of where the interest rates were sort of pre-2010. I'm sure everybody, particular people that were on a tracker or variable mortgage previously, remember those days, and the fantastic day it started to drop and drop and drop down to the 0.5%. It was up to for some time. So within that there are opportunities, and that's kind of leads us on nicely to the property cycle, where we are in the property cycle. People talk about different types of years in terms of a 7-year, 14-year, 18-year. We've looked at an 18-year really based on the historical markets and the time it's taken for them to turn over. I think, I don't know about yourself, Manish, obviously I know you deal with lots of different types of properties and developments. We similar to ourselves, where we started the new year thinking we're actually going into a recovery phase. We're seeing, the market pick up. We're seeing more properties coming available. We're seeing properties selling. We had a property that we funded on the platform to one of our borrowers, a great guy who put the property on the market for sale. And at the same day, he got the full asking price offer. So we could see it really moving. But then obviously, with the crisis that's come into place, it's kind of stopped. And where do you see it picking up from here?
Yeah, you're right. I mean, we had 3 or 4 years of uncertainty, political uncertainty, and there was a lot of pent-up demand. So, we had that Boris bounce. And, I was expecting a strong 2020 in the property market. And, this thing has just come along. It's one of those black swans you describe it as, right? It's an
Yeah.
unknown which just came out of the blue, and so it will impact the property market. That's for sure. We just don't know when. You can see what's happened in equity markets and property being so illiquid. We don't know the magnitude of how much the market is going to come off. I think it will come off. This thing, we'll have a rebound for sure. At the moment, what's unknown is how much it will come off, and how long will be the sort of uncertainty around vaccines and new infections and all that sort of thing. So it's really hard to predict, at this stage, given where we are.
Some of our longer term. Sorry, Manish.
Yeah, I mean, sometimes you kind of use recent. You've talked about all of these various different infections before, so it's good to kind of look at that. What I focused on, which was on my latest article, is to see what happened in 08, 09 during the financial crisis. And equities, the FTSE went down by 43% from peak to trough. And the property market fell by 19% during that time. So it's not saying the same is going to happen again this time round, but that's just a recent example of the last crash. But then we had a very strong rebound from there, right? So that rebound will come, that's for sure.
It's interesting because one of the reasons we wanted to use this kind of particular graph and share it with people is because a few of the investors that we deal with that have kind of been through a number of cycles and experienced chaps, some ex-surveyors, etc. They referred to this as a cycle dip in terms of they felt that they were in recovery phase and there was going to be a cycle dip anyway, and then we would see a real growth. But that cycle dip, instead of being a small dip, it's potentially, it's unknown what it will be yet, but they see it that it will. It's following this phase again in terms of we will see this dip, but then we will see that explosion in growth. And unfortunately, as you said, we just can't predict how long this is going to take and where it will stop. But it's interesting that it's kind of following cycles that have happened before as well in the market. Obviously, in the UK, we're based in sunny northwest, and I know you're based in London, and they're typically classed as sort of two different markets, particularly London and Southeast. At the moment, relatively, it's been spoken to as sort of stagnant and not moving as quickly as the UK, as the Northwest and the North, and this sort of powerhouse thing has helped the North as well. It'll be interesting to see how that picks up, and if London starts to come out of that, and if it starts to, after this crisis, if we start to see the London market then pick up, because it's been a couple of years, hasn't it, where it's really slowed down. It's not had the growth that it's seen the years before. What we've done here is taken sort of the pricing and the growth in London and then compared it to other cities, and you can see that other cities are actually starting to close the gap in terms of the growth and average house prices, and it gives you a real good understanding of where some of the cities are that are starting to book those trends. And you can relate this then to some of the sort of top 5 hotspots that you see quite often in like the Sunday Times and places like that for the UK cities. Leicester was one of them not too long ago that was seen as a place that was growing, etc. So whether if we do eventually sort of, I don't think the Northwest will quite catch London up at all, but in terms of growth, if we start to see that, I think then that hopefully will inject London to start to get the growth as well, because you'll always have that ripple effect, don't you, as well? So when London does start to grow, when London does start to get busy, everybody around it starts to feel it and benefit from it as well. So hopefully, over the next couple of years will be a big benefit. I love this slide because this has been put together by our marketing team, and they use the words, so when you look at the slumps along the way, they're just mere blips. So I'm sure they weren't mere blips during the actual time it took place, and hopefully in the next couple of years when we look at the graph, we'll see this as a mere blip in the property sector as well. One of the things that is interesting, obviously, inflation and how it's affecting people's savings. And I know there were quite a few big news stories. I know we're kind of bouncing around about different areas, but we said that at the beginning. We're going to try and cover as many different investment and areas and classes, etc. during this presentation. This is quite an interesting one. I thought it was some nice sort of figures in terms of inflation and how it's wiping out nations' savings. So you can see here the growth of that. So you've got in the blue, dark blue chart, inflation. You then got next to that average savings, and this is the growth of them. So obviously, if inflation is growing more, it means we're devaluing our savings. ISA fixed rate tools, we've added those in there, and then obviously added ourselves capital for our 10% typical return, just to kind of show people what the opportunities are, and how it's important to utilize your savings rather than have them sat there, which a lot of people will do. Predominantly, they might have £1,000, £10,000, £100,000 sat in savings, and if you actually look at it, it's devaluing month on month. I don't know if you've got anything you want to add to that, Mish, or?
Yeah, the only thing I would add is I would say to people, don't believe the government's official inflation numbers, because that is just a pure manipulation of the data. There's been so many changes over the last few years how they calculate that data. I would say, my best guess would be that inflation is actually running at 5 to 6% per annum in reality, right? So this 1, 2, 3%, whatever they come out with, is a bit of a deception, because they're the ones who are going to, if inflation was actually running at in real terms 5, 6, 7%, if they published that, they'd have to increase interest rates, and if they did that, they're the ones who'd be losing out most, because they've got the most debt, and which is growing even more now. So I would say in reality, inflation is 5, 6%, which is even more of a reason to be making your money work hard for you.
I thought you were going to follow that with some kind of big conspiracy story there that we'll see on Netflix in a couple of years' time. So
that's to come.
Something that we don't know. That's the next one. We've also got a little touch on the ISA. So we are operating a ISA webinar next Thursday. So just kind of giving people information about what they can do with their ISA, how they can utilize it, particularly this time of year, because the deadline is the 5th of April, which we're trying to get extended, and I'll touch on that very shortly. But if anybody's interested on the sort of returns and how you become an ISA millionaire, then we'll be touching on that same time next Thursday and giving people a bit more information. And as I mentioned earlier, there are resources where you can download guides and find out if the ISA or the pensions or what type of pension is of interest to yourself. We'll share this so that people can have a good understanding. So some of the questions we wrote down for you, Mish. So, I think we've answered this one, to be fair. What do you think will happen in the property sector this time? I think, is it fair to say we've covered this?
Yeah, it's kind of hard to put a number on it, but if we use historical evidence, historical precedents, we're looking at potentially 10 to 20%, depending on the region. That may be mitigated by government policy. I don't know, but it's really hard to tell. Really, it kind of depends on how this whole thing materializes in terms of the virus.
Yeah, absolutely. And we're the same. We're kind of waiting to see how it pans out. One of the questions a lot of investors will ask, and I thought it'd be good with yourself being a very active investor. How are you keeping busy? Apart from looking after the kids, cleaning the house, and everything else. From an investor's point of view.
Yeah, and there's two things which. So the one thing, again, another plug. I've just published a new article on my website, which is about asking the question: has the stock market bottomed? And again, you never know until it well after the event. But there are opportunities. We've had a very, very sharp correction in the markets. You talked about it earlier, and there are some huge opportunities there. So have a look at the article. There are potential opportunities for dividend stocks. The reason I like dividend stocks is because you could be earning, while you're waiting for that bottom in the markets, We don't know when it's going to come. But what you can do is get some exposure to dividend stocks. So you could be paid anywhere between 5 to 10% for solid dividend paying stocks in the meantime while you're waiting for that rebound. So that's one way you can buy some high quality stocks. None of this is a recommendation, but I think we're getting close potentially to a bottoming. And the other thing is there will be there will be a bit of distress out there in the market. So if you're patient, you just have a look out for some interesting opportunities in the property market. What tips do I have?
It's interesting you say. It's
Go on,
interesting you say that, Manish, because we literally had a call yesterday with our regulators, being FCA regulated, about putting a fund or loan notes together, because as a business we've got a great network of people across the UK that identify good investment opportunities, and we want to be in a position that as soon as we've got that, we can move. Already we're seeing that. We had one, I was explaining to the guys yesterday, we were looking at about £960,000. Surveys complete, everything's done, and we've gone back to say, obviously the market have come back to offer it us at £700,000. So there's a huge discount there.
Wow.
Even with the market correcting, we still know that we'll do very well with it. So we're looking at ways that we can create a fund that investors can benefit from, and we can take advantage of the great network that we've got in place as well. So
yeah, I think that makes a lot of sense. Yeah.
So obviously you've just mentioned some of the tips. We've got a couple of tips that we've written down as well to help investors. So don't panic sell. I think that's quite an important one. Having a mix of investments, which we touched on quite a lot. Doing a spring clean of investments. So it's always a good time to sort of sit down, take stock of what you've invested in, or what your plan of investment is for 2020. It may have changed given the market change as well. So you might see a new way to invest and take advantage. Looking at projects and building in contingencies, or if you're reviewing projects, make sure there is a contingency built into it. Also looking at projects with lower loan to value, so having that equity element in an actual, if it's a property project, having the equity element in there to make sure that there's plenty of wiggle if needed. And the other one as well, don't miss the ISA deadline. So that's quite a key one, the 5th of April. I think that leads us quite nicely on to the petition that we started. So some of you guys may be aware of this. We've got a petition we started on change.org to extend the ISA deadline from the 5th to the 1st of October, really because we know the advantage this gives investors, having a return that's tax-free. We also appreciate that people are very busy. There's a lot of things that people are having to deal with currently. So be able to get the government to push this back, it just gives people a bit of breathing space, and they're not missing out on that advantage as well. So if anybody watching, if you kindly go to this petition, or you'd like us to send it over to you, contact us on the contact details at the end, and we'll happily share the link. So it seems to be getting a little bit of pace now, which is fantastic. If anybody's got any questions as well for Manish, I know we've kind of been touching on them throughout as we go along, but please feel free to fire them over. Happy to share them, or as Manish has said throughout his website, investlikeapro.co.uk. It's got lots of really good information on there. So you've got a registration area on there, haven't you, Manish, where people can register for updates and things like that? Yeah.
You just put in your email address, and you'll get regular updates and articles and even opportunities. So when I've found an opportunity that stacks up for me, I normally send that out to people as well to have a look at.
Fantastic. Some of the benefits with ourselves, so Source Capital, we don't charge any fees to invest. All our investments are secured with first legal charge. We generate a return of up to, it's a fixed return, typically 12% per annum. We're HMRC and FCA approved, and we operate on the basis we have a network of borrowers that we work with that provide us good investment opportunities. So if anybody is looking for to diverse their portfolio and interested, we do have download that you can download our website through our resource page, or feel free to speak to one of our team. We'll be more than happy to answer any questions. I mentioned last week about the ISA. Obviously, the deadline is coming if we're not able to get it extended, but If you'd like to understand a little bit more about what you can do with your ISA or how it works or how you can transfer ISAs, we'll be hosting a webinar at the same time next week. We'll be sending the details out along with this recording as well. So if anybody does have any questions, please feel free to ask. Alternatively, you can contact us on these details. We do appreciate everyone's time. See, there's a really good group of people on board. I see a couple of questions that have just popped up. One question from Matt regards to you've opened an IFISA this year. Can we open another one? You're not able to yet, Matt. If you've put your limit into that ISA already, it will be on the 6th of April. You'll have to open the next to invest into from there. Any information like that, any technical information, we're happy to speak to you directly, or alternatively, we're happy to provide you the guides and information there. We've got a couple of questions from Anton. So, how much opportunity from raising investors? Wanted to get into both Manish Stevens' input. So, question for you, Manish, if you'd like to start this one. So, how much appetite do you currently see from fundraisers and investors? Quantitative data would be helpful. Sorry, it was the same question twice, so apologies. I was just reading ahead to see if anything further I could ask. So, are you still seeing an appetite from investors when you speak to them? How are they reacting when you talk to them about projects?
It's limited, obviously, for obvious reasons. People are kind of sitting on their hands somewhat at the moment to see how things are materializing. But there's, there is some interest still out there. People have been, on the phone to me asking about the lower risk investments coming through. So people still have an appetite for low LTV, first charge stuff with, good, good cushion. So good equity cushion, where even if we were to have an even bigger collapse in the property market, you'd still be safe, right? Because if you've got a relatively low LTV, you're still going to be safe on the other end. So there is still interest from there, but obviously the levels of interest have come off since January, February time.
Yeah, fantastic. Similar for myself, Anton. I know you've asked us both the question. We're finding larger investors or people that have been in the sector for some time are putting more into this because they're doing that in terms of spreading across different classes. Newbie investors are looking for more information, maybe taking a little bit longer to make a decision, wanting to understand it more. And yes, we're seeing it take the cycle to get investment is going to take a little bit longer. But yeah, generally people are still relatively active and want to talk, want to understand it. I think people are just seeing what happens over the next 2 weeks, particularly with the fact that we're getting updates from Boris, which I think is fantastic on a daily basis. It's encouraging and comforting. People are looking to see what happens in those daily updates to see, is it now starting to slow down, or are things what's happening with that? So, but yeah, hopefully as things start to settle down, we'll start seeing the activity grow and grow and grow and continue. We've got another comment there from Keith as well. So great webinar, guys. Many thanks. So I think we'll finish on a high there, Manish.
Great. Okay. Good stuff.
Yeah, thank you very much for your time.
No worries. I just want to leave people with, something on a positive sentiment to say, look, we've had this before. We've had many instances where we've had scares and concerns, and we've always had the market bounce back. And if you compare this to 08, 09, the credit crisis, the government and policymakers are much more ahead of the curve this time round compared to last time. And the other difference is all the banks were, in danger of collapsing at that time. But right now, as things stand, banks seem to be in better shape. So that's positive for the property markets. Yeah, absolutely. Absolutely. No, I appreciate that, Manish. Appreciate your time. I know you're a busy chap, and I'm sure everybody on the webinar appreciates that. It's been some really good insights, some really good comments and questions as well. So everybody have a great day. If you do have any questions, queries, please feel free to contact us. And as I say, we'll be sending this recording around to everybody to have a look at as well. So enjoy the rest of your day. Thank you very much.